Hello, my name is Nick Quinn.
And I'm Shane Vernier.
And I'm Connor Woods. We are the market analyst team at howtotrade.com, and together we're going to explain everything you need to know about trading the double bottom pattern. So let's get started.
A double bottom is a bullish chart pattern and it signals a reversal in trend. Therefore, it only ever occurs at the bottom of a downtrend. It's got two distinctive pushes into or around the same support level before it then bounces back to start a new bullish up move. Traders would use it to confirm a long entry, and it's very easy to spot because of its distinctive shape. It looks just like the letter W. So let's break down exactly how we'd go about identifying it. A double bottom is a really easy pattern to spot on a price chart, and there's a few simple techniques that we can employ in price action to help identify it properly. What we're obviously looking for first of all is a downtrend, and we're looking for the first initial low here to be retested. So we're looking for price to retrace and then make a attempt to make a new low, but basically pause at the first initial low. That's where we would draw in a first trend line of support. From here, we're looking for price to now start to retrace up. Once it does, we're looking for the swing point that sits between these two initial lows, which in this case is this here. That is where we would now draw our next trend line in. And it's even stronger if we can actually connect it with the support structure in the initial move down. That makes it a lot stronger. We're looking for price to then rally up or trend up. And then when it gets to this trend line that we've drawn in, we're looking for a candle which breaches the level, breaches the trend line, and then prints a close above there. That is our trigger for getting long in the market. So what we do is we'd enter a long position at the close of that candle, and then we would then look to place a stop loss. The way we would do that, there's a few different ways that you can do that. You could either place your stop loss very tightly underneath the level. An alternative could be the candle that breaches the level. We could place our stop under the low of that candle. Or even stronger, or even more conservative, we could look for the trend structure that we're currently in that's created that move and maybe set a stop loss under the near-term support that was created. But that's the correct way to identify a double bottom.
So to be honest, the double bottom chart pattern is certainly its most effective when it appears at the end of a downtrend. And when this happens, we can see the price potentially reverse and move up higher. And I've got a really, really nice example on the chart. What we're looking for is that W formation. So you can see the neck of this W coming here. We can see the market clearly in a downtrend. But here we have low number 1 printed and low number 2. That creates our W formation, and then we start to move higher. As soon as we get a break above this neckline, this initial neckline, you can see how the market just sort of starts to run away, and then you can see the real momentum shift in this market. So although the double bottom pattern can be used at the end of a downtrend for a reversal, it can also be identified in a ranging market. And we've got a great example here on the chart. You can see in general the market's not really knowing where to go. It's trending in this range bound. Now if I get my drawings up on the chart, we can use the double bottom formation to identify that change in momentum. So you can see here we've got low number 1 printed, we've got the neckline of that W formation, low number 2, and from there we had that expansive move which is broken in this initial neckline. That's the start of that momentum shift in this market, and from there you can see how we really change momentum to the upside.
Okay, let's look at a few of the key pros and cons for the double bottom pattern. On the pro side of the ledger, if price breaks above the neckline, there's a high probability that the next bullish trend will be long and sustainable. So long entries are warranted if you do see price break above that neckline. Also, the double bottom can be viewed on multiple chart time frames across all markets. So it's commonly occurring really throughout the world of finance. And lastly, the double bottom can be identified in trending and ranging markets, which makes it an extremely versatile technical indicator. On the con side, in some cases, a double bottom formation can become a triple bottom pattern, and the stop loss will be triggered. In this instance, it's a false signal. We don't get the breakout that we're anticipating, and initially, our stop losses are triggered, passing along a financial loss to the trader. Lastly, usually this trading strategy is more suited for day traders rather than long-term investors. The pattern can be applied on longer time frames, but it is designed and functions well on intraday and daily periods. Now, let's review some of the key takeaways from the double bottom pattern. Number one, the double bottom pattern is a bearish momentum reversal that looks like the letter W. Number two, the double bottom formation has three main elements: a first low, a second low, and a clear neckline. Number three, the double bottom is most effective at the end of a strong downtrend. Number four, it is important to confirm that the pattern is valid with other technical analysis tools such as RSI and moving averages. Now, if you want to learn more about the double bottom pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you exactly how to fit the double bottom into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real market price action. You'll have everything you need to practice and gain experience. And once you're ready, feel free to join our How to Trade Funded Trader program.